Hello, everybody. Welcome back to the Stock Market Brief Show. We got ourselves a jammed-packed update today with lots of moving parts. The market is continuing to rally, but we are seeing an interesting shifts in yields and the U.S. dollar. So let's dive into what is driving these moves and break down some of the crucial announcements across the Fed, corporate earnings, global markets. I'll be covering even sectors that are in the spotlight, expected moves in the S&P 500, current market conditions, and sharing the chart of the day. Let's get into it. Welcome back, everybody. We're taking a look here at the heat map of the S&P 500. Stocks did continue to rally today with tech-heavy NASDAQ 100 leading the way. You can see that here. We can look at the 11 sectors that make up the S&P 500. And what you'll see here is that communication services, tech, and even discretionary led the way, while financials, industrials, and energy lagged behind after Wednesday's surge post-election. Now, today's market sentiment seems to be reflecting a Trump fade as the yields pulled in a little bit and with the dollar pulling back from its recent highs. We did have Jerome Powell come out today over at the Fed, and as expected, they did cut rates by 25 basis points, bringing them to a target rate of 4.5 to 4.75. Fed Chair Powell struck a balanced tone today, emphasized that they are ready to either speed up or slow down the easing process, just depending on how the economy reacts. He did mention that inflation is eased, but remains somewhat elevated, while the labor market is stable. Outside of the U.S., central banks were busy too. The Bank of England also cut rates by 25 basis points, but they did hinted at a cautious approach, while Sweden's Riksbank went with a sharper 50 basis point cut, and Norway held steady. These decisions reflect their broader theme of global central banks carefully managing economic risks while balancing inflation. If we turn over to corporate news and earnings, Lyft saw a massive move. Under Armour saw a massive surge with better than expected earnings. Qualcomm approved a $15 billion repurchase program, and Gilead Sciences reported solid revenues and EPS beats, highlighting resilience across several major sectors. Overall, it's been a mixed but optimistic earnings season, with companies generally outperforming their expectations. When it comes to these earnings, I really like to track the ones that have big moves to the upside. The reason for it is because once the move digests, I look for setups then thereafter. So Lyft is going on my radar. UA is going on my radar for a period of digestion. Qualcomm, albeit it is still chopping sideways, but I am interested to see if this starts to resolve higher. And in Gilead Sciences, this was a very powerful earnings move, and now I'll be watching this to see a period of digestion. On the economic data side, we did see jobless claims in line with expectations. Although they continued to rise more than anticipated, unit labor costs increased by 1.9 for Q3, which was above the 1% forecast. They signaled that while wages are growing, productivity gains are also helping keep inflation in check. Now, all this is taking place while crude oil prices remain choppy. They did end the day up, partly due to probably the weaker dollar and ongoing geopolitical risks in the Middle East. Gold saw gains as the dollar dipped, continuing its trend from the past week and recovering a little bit from its post-election jitters. So that covers today's major news, but we'll take a closer look now at the charts to see how these events are impacting technical patterns. We'll go over expected moves, sector spotlights, and the chart of the day. Now, market conditions. What are they? They are bullish. Why? Well, there's two things that I look specifically for as a swing trader when it comes to market conditions changing. And that is, are we or are we not above a gamma flip line? And as we stand right now, we are above the gamma flip line. And when we're in positive gamma territory, volatility typically reduces, and dealers look to buy the dip and sell the rip. So that is check one for bullish market conditions. That does not mean that the market can't come back down. And if it comes back down, what do we say? Well, we look to see if it's still in positive gamma territory, and we look for strength after to see if it creates opportunities to buy that dip. The next thing I look at is the direction of the 5-day moving asset. 5-day moving average across various assets. You have SPY here, Qs here, IWM, semiconductors, biotech, and DIA, which is the Dow Jones Industrial, the diamonds. And you can see we're above a rising 5-day moving average. Check, 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 check. All is green. That is why these market conditions are bullish, albeit they are extended after a 2-day rally. but that is okay. We look for periods of digestion and for price to calm down for new setups to occur. If we take a look at the expected moves, we'll look at what the expected move and how it played out for today and give you the updated one for the S&P 500. If you're interested in getting these daily expected moves sent to you, I have a Discord group or a Patreon where you can sign up with Patreon and then sync your Discord up, and that's in the pinned comments. If you take a look at SPY right here, you see that we did come into the daily expected move and we closed basically right on it for the trading session. Remember, if you think of this terms of probability, 68% of the time, it will close within here. Yesterday was a day that it did not. We are currently outside of the weekly expected move and we're near the upper monthly expected move, and we still got a lot of time left in this month. So it's going to be important to watch to see how this market digests. Qs closed outside of its expected move and we're currently outside of its upper monthly expected move, and it's only November 7th. IWM finished rather flat on the trading session and it did not tag either of its expected moves for the day, but you can see it's hanging around the anchor volume weighted average price from the low of the day on November 6th, the day after the presidential election. You can see we're also outside of the monthly expected move and the weekly expected move. So IWM saw a massive run. Now we're seeing price digest just a bit. Let's update the expected moves for tomorrow's trading session. To below us, we have about a zone from 592 down to about 590. You can screenshot this, put these levels on your chart. And if price were to come down here, that's roughly around the presidential VWAP right over here. And we can see how price responds in and around these areas. We're well above the week to date and we're well above the weekly expected move. Above us would put us, if we go tomorrow to hit up in here, this would make S&P 500 hit another new all-time high and reach up into 600 for the very first time. So be prepared for that to take place. All right, I want to show weekly expected moves. So also part of the Discord group, I show weekly expected moves where I'll give what the weekly close is, the weekly expected move. I'll give an upper level, lower level, and 2 sigma levels. But I'm going to show you it now, and I added this column over here that says outside, ? And basically there's 3 colors, right? You're only seeing 2, but there's technically 3. If it's green, it shows that we're outside of the weekly expected move. If it's yellow, it's still within it. And I just wanted to call out that the majority of products that we track here, from mega cap stocks over here, Apple, Microsoft, Google, Amazon, so forth, all of them, except for Apple, right, is above their weekly expected moves, right? S&P 500, SPY, Qs, IWM, DIA, all outside. The ones that are in yellow, you got something like utilities, consumer staples, healthcare, right? Biotech, which we'll talk about this one on the sector spotlight, and gold miners. Down beneath this, you got bonds, gold, and silver there too as well. So this couple-day rally is pushing moves that are exceeding what the market anticipated as risk, but there are some assets that are just holding well within those ranges. Let's take a look at the sector spotlight. These are individual sectors that are still on my radar that we talked about in the past. I want to start off with biotech. Biotech is in an overall larger formation known as an ascending triangle. In short, it's basically showing us the market and buyers, getting stronger. They're stair-stepping price up into a pivot of about 104. And you can see 104 is kind of where the bears keep knocking price back down. Now, earlier, a few days ago, price action was coiling up within this pattern, which opened up a low-risk, high-reward opportunity to play it back up into this band. And then we saw the squeeze up into these levels. Now, what I'd personally like to see is the consolidation of a few trading sessions, whether that's to the upside and then the downside, or pulling in a little bit to reset up for a potential breakout of this larger structure that's taking place. So this is on the radar. Even if it pulls back down to around 100, I'd be paying still very close attention to this, as we are seeing a series of higher lows into and around that 104. The next one I want to talk about is XRT. I brought this one up on an episode probably a week ago or so, and I just saw a bunch of higher lows above a rising 200-day moving average. Price got a little excited over here, and you can see that the 20 days is going to start turning up and the 50-day rather flat, but it can turn up too. So I'd be looking for consolidations here and potential moves out of this larger base that's been really kind of a year long. And if it does break out, sometimes measured moves just double the base. And what that means for us is we can see price, if it reaches a measured move, come from around 79 to up and around 87. But more importantly, you don't need to trade the actual asset themselves, XBI, or retail, which is XRT. You can find out what the holdings are inside of this by going and Googling it, or you can look at the Analyze tab in Thinkorswim, and you can look at individual stocks that may be setting up as well. That means that if this does good, chances are some of the top holdings will be doing good as well in those sectors. Let's go to the chart of the day, and this one is looking at the times that the 3-month yield got above the 10-year, the 20-year, and the 30-year as far as being inverted altogether, right? So over here, you'll see there was a time where the 3-month, that pink line, got above the 10-year yield, the 20-year, and the 30-year. So it basically says they were all inverted. Over here in 2006, 2007, it did the same exact thing. And I'm bringing this up is because once they began to uninvert, also when the Fed began cutting rates, we saw this line come down, which is the 3-month rates, Fed dropped rates, and we started to see a lot of turbulence in the market, both in the dot-com bubble bursting and we had the financial crisis. Now, obviously, times are always going to be different. It's always going to be different no matter what. But I do want to call it out that we've been inverted, the most inverted we've been for a very long time, and the 3-month has been inverted across the curve, 10-year, 20-year, and 30-year. And they're starting to steepen significantly here to the point where, guess what? We uninverted. We're kind of floating back and forth on the 30-year 3-month. The 20-year 3-month has uninverted. You can see that as well. But the one that we have not seen uninvert yet is the 10-year 3-month. And my thought process was, if the Fed is going to continue cutting rates, we are going to see this uninvert. So we'll probably see this uninvert in the very near future as the 3-month yield curve tracks the federal funds rate very, very closely. So does that mean we're going to have the same type of outcome? No, that doesn't mean that. But understand that, hey, this is what happened. This is what has happened in the past. So it's going to make it that much more important for us to really respect price action if it starts going against us and volatility really starts to pick up. There's no need to really panic when we're in a proper bullish market conditions, when we're when we're above a gamma flip line, when we're above a rising 5-day moving average. But when these change, when the market conditions change from bullish to bearish, you want to really respect that, because things can get wild, and they can get wild very quickly. Hope today's episode helps out everybody. See you on the next.